Just to kind of cut to the chase, the banking crisis is not over. The crises don't happen all at once in one day. They emerge. Regulators deal with them. The new investors come in, they go, it's all good. We got this under control. And then there's the quiet period, and then they just pop back up again because they were never fixed in the first place. Let me explain why the banking crisis is not over. And for here, we're going to use a little financial history, which is underrated, but in my view, extremely valuable. Maybe just because I've been around long enough, I'm kind of a magnet for trouble when it comes to this. My first banking crisis was the Herstatt Bank in Germany in 1974. You have to have been around a while to remember that when that was a foreign exchange, that was a bank where in those days, if you were in Germany in the US and you were doing foreign exchange trading, and you sold it as Deutschmarks because before the Europeans sold for dollars, you would or bought them either. They would deliver the Deutsche Marks to you in German time. And then you pay the dollars in New York time. They failed in between. They got all the Deutsche Marks, but they never paid the dollars because they failed in the middle of the day. And that started a crisis. But anyway, it's a long list. But let me point to two in particular. For the first one, I had some front row seat, 1997, 1998, the Asia-Russia LTCM financial crisis now, what people don't realize. People remember September 1998, LTCM is gone. They're about to squander $1.3 trillion in derivatives. Is back when $1 trillion was real money. The Fed had no interest in bailing out a hedge fund. I was their lawyer, how we didn't expect to bail out. We're like, why would the Fed do that? Well, the answer was, it wasn't about us. It was about the 19 banks that were going to fail if we fail because they're dealers. So if they sell us, $1.3 trillion of derivatives, which they did, they buy them from the other side. And they're relying on the fact that they have a two-sided position and they make a spread. That's what they do. If one side of the trade goes away, all of a sudden, they're not sure they're naked on the other side and they got to go out and sell stocks. Like $15 billion worth of stocks to cover the fact that they were long that much on their side of the swap. Well, I can tell you what $15 billion of the fire sale stocks will do the stock market if they were to close the New York Stock Exchange and a lot of us besides. So technically, they were bailing us out. We've got $4 billion in cash. I'll put the fire off, but they were really bailing out Wall Street. We lost the money Wall Street put in, the $4 billion, but then Wall Street owned it and they got all their money back a year later, but they put out the fire. But here's my point that didn't start in September 1998. That started in June. In Thailand had a run on the bank dollars were leaving the country. They had pegged the Thai baht to the dollar and people panicked, they said, because money had been going in for resorts and casinos as well. And everybody wanted their money back, taking the dollars out. The Central Bank of Thailand could not maintain the peg they imposed. Capital controls said no more dollars and we're going to devalue the baht, which meant for us investor, all your money was worth a lot less. That then pretty quickly spread to Asia, and then it went to Korea. But here's the point. It entered a quiet period. In December, January, February, things calmed down and everyone said it's okay, by the long-term capital was fine. We at the time, we were like looking to Asia for investment opportunities. But then it came back in April in a small way because Sandy Weil was selling, he was merging city and travel. And he told the Sama guys, I don't want any volatility in earnings because I don't want to mess up this deal. So you guys have to reduce your books. But the process of Solomon getting out of swaps widened the spreads. We're sitting there long-term like a spread's blown out by more. And then of course it came to a head in August. Russia defaulted on their internal debt or external debt divided the roof, was like a trifecta. And then that caused the panic and then it got worse. And then finally the bailout advanced September. But my point is that took a year and almost a year and a half or so long quiet period in the middle. So just when you see a crisis evolving and then there's a quiet period, don't assume it's over. It just means that things have been patched up, but it's still percolating below the surface. The second one, of course, the 2007, 2008, 2009 global financial crisis. Now what happened there? Everyone remembers September 15, 2008. Midnight on a Sunday, Lehman Brothers filed for bankruptcy. Okay, that started in the spring of a 7 HSBC reported lower than expected earnings because mortgage losses and subprime mortgages were higher than expected. And that's when Bernanke acts as on the record in the March minutes of the FOMC said this will blow over. Yeah, and then it kind of came to a head in August 07. That's when Jim Cramer and Aaron Burnett on CNBC, because they know nothing. They know nothing. And Cramer was right. They actually didn't know anything that the Fed, they kept the discount rate and they got the Fed funds rate. And then September, remember the September 7, Hank Paulson's Treasury Secretary, he announced the Super Serve, special investment vehicle that was going to buy all the credit card receivables from all the banks with government money and then put them into a fund and work them out and all this stuff, which never happened, but it was a dumb idea, but it never happened. But then in December 2007 into January 2008, what happened? The sovereign wealth funds bailed out the US banking system, Abu Dhabi, and they were capped at 10%. But Abu Dhabi bought 10% of Citi Temasek in Singapore, but I think 10% of Morgan Stanley Kuwait investment on one by one. The sovereign wealth funds bailed out the US banking system. So January or good February, it's all good. What happens in March? Bear Stearns blows up because it wasn't all good. That was the point. By the way, if you ever see a CEO saying it's all good, get your money out, then it's not that they're lying. It's just that they don't realize how quickly things can change. So March Bear Stearns blows up. What's happening happens in June. Fannie Mae. What happens in July? Freddie Mac. What happened in August? The Congress passed legislation bailing out Fannie Mae and Freddie Mac. So once again, this is your second quiet period. It's all good. The Congress saved the day even though Bear Stearns. Fannie and Freddie had just blown up the Congress, in theory, bailed them out and was all good. And that lasted about a month. And then September, here comes Lehman. So my point is, financial crisis can have one or more quiet periods. In fact, they usually do. Everyone remembers that when the Krakatoa erupted, but they don't know when the shaking began. They forget that these things usually have a year or longer. So if that's the case, and it is the case, those are just the facts. What should we say about the 2023 banking crisis? Well, we have this again, March 9th, March 10th, March 12th, March 19th, May 1st. The sequence of failures, big ones, including Credit Suisse, we're in the quiet phase. Everyone thinks it's all good. So let's put a finer point on that, and I'll go through this quickly. Downward sloping yield curves. Now, the yield curve is just the x-axis or the maturities.
In conclusion, the banking crisis is far from over. As we've discussed, these crises don't simply erupt overnight and resolve the next day. They unfold in stages, with periods of apparent calm followed by renewed turbulence. History teaches us that initial disruptions often give way to a deceptive quiet phase, only for underlying issues to resurface more violently later on. Whether it's the Asia-Russia LTCM crisis of the late 90s or the global financial meltdown of 2007 to 2008, the pattern is consistent. Early warnings, temporary fixes, and then bigger explosions. The current banking crisis of 2023 is likely following the same script. We've seen significant failures and interventions, but we're now in a quiet phase where many believe the worst is over. However, the downward sloping yield curves and tightening liquidity suggest otherwise. The big money is bracing for a recession and possibly another financial crisis, signaling that the quiet is just an illusion. So as you navigate the financial landscape, remember this key lesson. A lull in the storm doesn't mean the storm has passed. Stay informed, stay cautious, and be prepared for the turbulence ahead. Thank you for watching, and be sure to stay tuned for more insights on navigating these challenging times.